Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
When it comes to retirement planning, one of the most important components is generating income to last you through retirement. On today's show, how you can do this despite challenging economic conditions. It all starts right now.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you got individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome in to How to Retire with Ben Fuchs.
Welcome on into the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan, and Ben is here to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience in the business. Of course, he's with Fuchs Financial, and all the things we talk about on the show each week are vitally important to you, retirees. You want to know about wealth accumulation, asset protection, long-term cash strategies, Social Security, and so much more, and that's what we cover each week here on the show. So let's welcome Ben in. Ben, how you doing today?
Doing all right, Gary. Glad to be here.
Yeah, I'm glad you're here, too, because we've got a great show, and Ben and I were going through the show before. We got some audio clips we want to share with you, too. I'm going to start out with a great quote. I love this one. This comes from Walt Disney. I heard there's going to be a recession. I decided not to participate. One of my favorite Walt Disney quotes. Yeah, I love that.
Excellent.
Yeah. And he didn't for the most part, right? Anyway, so let's get going.
I mean, I think he did okay.
Yeah, he did. Yeah, it all started with that little mouse, right? All right. The State of the Economic Union has folks across the country worried about what the future holds. For those in a financial red zone approaching retirement, these economic conditions could change the trajectory of their retirement. Don't worry. Do not fear. Going to help you cut through the confusion and offer tips and takeaways that'll help you find your footing amid market volatility and inflation. Okay, here, what we're going to do, man. We're going to start off with Campbell Harvey. Now, he's a professor of finance at Duke University. Now, Harvey joins Squawk Box to discuss the Fed's inflation fight and provide some historical context to offer perspective regarding the economic forecast for the year ahead. I'll get your comments on the other side.
Recession at this point is a self-inflicted wound. If you look at what's happening, the tightening is very severe, and it's not just a short rate going up so quickly. It's the long rate, too. Uninversions happened before recessions, the last 4 recessions. But in this particular episode, the long rate has gone up, and the long rate is very damaging. It increases the cost of capital, makes it difficult for businesses to invest. It craters the housing market with mortgages at 8%. This causes implications, and indeed our financial system. So our banks are taking a hit right now. All of this points to weakness in 2024.
All right, my friends, if you're in the car, please do not drive off the road. Pretty negative from Mr. Harvey, Professor Harvey, don't you think?
I mean, the whole concept of what the Fed does is cause and effect, right? We're going to raise the rates. We're going to reduce economic activity. We're going to basically, not so subtle way, we're going to hurt the consumer, right? What does it mean when we raise interest rates? Well, it does make it harder for businesses to grow. How do you mean? Great question, Gary. Thank you so much for asking. So if I am a small business, which I am, and let's say that I was taking a loan, which I am not, but let's say that I was taking a loan of $1 million and I was getting a rate of 5% on that loan, I have to pay $50,000 a year in interest. Now, let's say the rates go up about 5%, which, they have. Now, all of a sudden, I'm not paying $50,000 a year in interest. I'm paying $100,000 a year on interest in addition to the principal that I obviously have to pay back. Now, that's going to stifle growth. the payments that I have to do, the interest that I have to pay is going to double. Obviously, we've seen interest rates in the housing market go from the below 3 to 3 to 4 to all of a sudden up to 7 and 8. So in some cases, they've doubled. Sometimes they've more than doubled. But everybody who has anybody that's trying to buy a house right now and can't pay cash understands the pain of what that means. And not only that, obviously, we see inflation through the grocery store. I just went to Whole Foods and paid more than I think I have ever paid for groceries in my life. But it does cause pain, it does cause concern, and it is something that we need to look forward to and plan for as we look ahead.
You know, every time I leave the grocery store, Ben, I mumble to myself, and people think I have Tourette's or something because it's pretty brutal out there. It really is, you know. Gosh, it's awful. Yeah.
It is, and they brainwash me into believing that I need organic stuff, so I do it, even though I'm like, this could be a scam, but I don't know if it's actually, I'm going to buy it anyway.
Yeah, exactly. Yeah. Okay, well, it can't hurt, that's for sure. All right, I want to move on to Jeremy Siegel. He's a professor emeritus of finance at University of Pennsylvania's Wharton School of Business. I think I've heard of them. Anyway, they joined the conversation to discuss the latest market trends, rising treasury yields, and much more. And we'll get your comments on Mr. Siegel after the clip here.
I was looking at we're 10% off the low. We just entered correction territory for the S&P. We did it a few days earlier for NASDAQ. We're 15% off of that October low of last year. And I went back 50 years, and if that October low holds, which I very strongly believe that it will, returns in the market over the next 1, 2, 5, 10 years are very, very good. In other words, if you can invest 15% off of a bear market low, which is what we had a year ago, your subsequent returns have exceeded the market by quite a margin.
All right, before we get your comments, Ben, I want to remind everybody the show is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. Want to thank you for joining us, spending part of your weekend with us. Want to get you a phone number right now, so get the How to Retire blueprint. You can benefit from that, that's for sure. Call right now. Still have a limited number of availabilities on our calendar this week. No cost, no obligation. That phone number is 800-380-8985, 800-380-8985. Get the How to Retire blueprint. The folks are standing by at Fuchs Financial, ready to get on the calendar. You deserve a more confident plan to retire. Stress-free, peace of mind, that's what you want when you move into retirement. All right, Jeremy Siegel, a little more positive than Mr. Harvey. Mm-hmm.
Well, I think they can both be right. I think a couple things. Anytime you're looking at a 10-year period in the market, most of the time, the vast majority by percentages, you're going to see growth. With that being said, every single piece of marketing material that I've ever had to get approved by compliance always has this disclosure. It says past performance is not indicative of future value. Every single time. Now, I love the idea that we're taking numbers and we're extrapolating for the last 50 years, for the last 70 years, for the last 100 years. I don't care. We're trying to use numbers that happened in the past to predict the future. And sometimes they're right and sometimes they're wrong, but it's interesting to talk about. But for me, it just does not hold value. Every time we're looking at a person, we're looking at how to manage their money individually. And it's not based on what this stock market index did yesterday, what we see coming. It's more about where are you in the process? How close are you to needing this money? And how much risk can we actually take with it? Because sure, I think that right now, I am slightly more positive on the market than I have been for the rest of the year. We're finally seeing somewhat of a pause in the uptick in rate activity, right? The Fed Reserve was basically saying, hey, we don't really need to raise rates anymore. Now we're at a point where we're comfortable, and we're seeing all of that with all the leading indicators. They've all gone down, which has made the market go up. Does that make sense? Of course not. But what they think... what they believe is that because all these leading indicators are down, that means the Fed is going to stop raising rates because what they call economic tightening, or what we call pain at the grocery store, has started to happen. So their goal is to curtail inflation, but that also limits our buying power. It limits our opportunity for growth. So there are two sides to that coin. I am cautiously optimistic right now, but I also don't want anybody to take unnecessary risk just because somebody might be cautiously optimistic.
Mm-hmm. And that's why it's so important to use other investment vehicles that are perhaps less risky than the market, Ben?
Yeah, it's important to have a combination. I think that at any point in time, you always want to be in the market. Now, what percentage of your portfolio is in the market is different. 80, 90, 100% in your 20s, 30s, and 40s, great. Should you be 100% in the market in your 70s or 80s? Probably not. but it's important to have a portion of that because you always need to have money that you're not using right now that is there for long-term growth, that is there to beat inflation. And historically, the market has done that. So it's about creating balance. We don't know what's going to happen in the future, but we need to be prepared for any eventuality.
Yeah, Ben does not have a crystal ball. He's got that magic 8 ball, and that's about it, but it doesn't work for the market.
That is how we make all of our investment decisions. We shake that ball, we throw it up in the air. Whoever catches it reads out what comes next, and we stick to it.
I like that a lot. All right, speaking of risk tolerance, Jim Cramer, who's always calm and mellow, is going to round things out by sharing
not
his thoughts.
excitable dude.
Not emotional, talk about the emotional investor out there. And here's what Mr. Cramer had to say.
I'm always telling you that nobody ever made a dime panicking. Because the market does a very poor job of taking care of sellers who want to exit all at once. In fact, sellers who exit en masse get hurt.
The house of pain.
Much worse than buyers who try to come in at the same time. Just like a rout at a stadium, if everyone tries to leave all at once, well, you know what happens. The asymmetry is well known to professional money managers, although that might surprise you, given how often these guys come on our air to foment panic. Hey, what's that about? I also like to remind you that even in the ugliest environments, good things can happen. And that's why it's important to know your stocks and know your companies. Otherwise, I know you're going to get swept away by your emotions because that's the way people are. And if you let other people sway your emotions by their actions, you tend to sell at the bottom.
Yeah, back away from the keyboard, take a breath. What do you think about what Jim Cramer had to say?
Yeah, I think one of the biggest things that I do for my clients is keep them from panic selling. We talked about the metric at one point that a Vanguard study said that over 25 years, a client with a financial advisor and typically on average, made nearly double, almost double what somebody without an advisor would do. And that's because somebody with an advisor understands the long-term impact. The whole concept of you don't negotiate for yourself because you don't want to get emotionally involved. That's the whole reason that you have a financial advisor, somebody separate from the piece that is going to make those decisions for you. With that said, look, with all due respect to Jim Cramer, I don't think this is the guy that's promoting calm. I mean, you roll up your sleeves, throwing papers all around. Every time he talks, it sounds like he's defending himself, even though he's making valid points. I can't disagree with that. I shouldn't go at him that hard. He was a brilliant guy. But he also has an interesting track record. You heard about the study that people that went against Jim Cramer ended up like tripling the market, and people that went with him did not beat them. Anyway, moving on. Look, I think ultimately there's a lot of different voices out there, and I think that's the point, right? You have a lot of people coming in a lot of different directions trying to tell you the market's going to crash, the market's going to go up, don't panic sell, buy gold, don't buy gold. The reality is that you need to have a plan. And when you have a plan and you are confident in your plan, you don't have to worry about all that other noise. Our goal at Fuchs Financial is to provide you with a plan. The reason that we have openings on our calendar each week, the reason that we do these shows is to help people like you who feel like there's so much information out there and they just want to cut through all of it and figure out what is in their best interest. How can we create a unique plan for them?
Ben, that's a great 4-letter word, plan. We like that. You need that plan. You need the How to Retire blueprint that Ben and his team will put together for you when you meet with him, because you deserve a more confident plan to retire. This is your chance to benefit from the How to Retire blueprint. Call right now. We still have a limited number of availabilities on our calendar this week. And remember, the consultation is offered at no cost or no obligation. 800-380-8985. 800-380-8985. When you meet with Ben, he's not going to roll up your sleeves and throw papers at you. He will not do that. Okay? Unless you want him to do that. I do
reserve the right to roll up my sleeves.
Yes, you do. He can roll up his sleeves, though. All right. Get the How to Retire blueprint. Here's that number one more time. 800-380-8985. The How to Retire blueprint. The folks are standing by at Fuchs Financial. All right, Ben. Great first segment. We'll take a pause here. We'll take a little break. Be back with more of Ben and How to Retire in just a moment. What's up next?
All right. How do you plan to withdraw your retirement income? Where do you plan to take it from? In what order? You could lose thousands upon thousands of dollars should you withdraw retirement income in the wrong order. Coming up, retirement, win, lose, or withdraw is next.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well, and it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. And Ben is back with us to help you take charge of your money. A little bit about Ben. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience in the retirement planning business. Of course, he's with Fuchs Financial. Each week we talk about wealth accumulation, asset protection, long-term care, and so much more in Social Security as well. So let's get back to the show right now. Okay, so picture this, if you will. You're months away from your retirement. You've saved diligently, feel prepared, and are counting the days till you enter that new phase of your life. But where will your monthly income come from? Do you have a plan which accounts for you draw from and when you plan for them and how much you're going to be taking from each? What accounts are you drawing from first, second, and fourth? These questions are incredibly important to address. So with the help of Ben, we are here to offer you some tips to help you win while preventing unnecessary losses along with the path to withdrawing those funds in retirement. Wow. I can't believe I said all that, Ben.
You did great.
Thank you, sir. I appreciate that. Okay, with that in mind, let's start with the first one. Withdraw from your retirement accounts prior to your investments. We've talked about this in the past. This is not a good strategy.
Yeah. If you dive straight into your 401k or IRA, you could cost yourself years worth of income in retirement savings. We have to understand that you put that money in there with the understanding, with the goal of long-term growth. Now, even if you retire right away, sometimes you do not want to pull from those retirement accounts. You still want to leave those alone, let those continue to accrue, and make sure you have a plan for how and when to withdraw that money.
You know, I think
a win.
Yeah, go ahead.
In a lot of cases is drawing from your investment first and allows your retirement accounts additional time to compound interest. Now, there are stipulations. When we are creating a tax plan for our clients, an individual tax plan, where we're sitting down and we're going through when to take money out of which piece, sometimes it does make sense for us to take money out of those investment accounts first. We want to look at when we're paying capital gains. We want to look at what we're getting for dividends. We want to see where we expect those pieces to grow in the future. Sometimes it makes sense to get rid of those first, and sometimes it does not. Sometimes we want to withdraw from the retirement accounts earlier because we have opportunities for wealth conversions and so on. But there are caveats to these. Again, I don't want you to hear a blanket statement on the radio when we're talking to thousands of people and directly apply any of that to your individual situation. That is why we offer those free consultations.
Yeah, and that's absolutely right, Ben, because, you know, every situation is different. Every plan is unique, and that's why we do the show. We ask folks to call in and get on Ben's calendar because he could put together that retirement blueprint for you, because yours is going to be very different from the guy next to you. That's for sure. So you want that individual plan, and blanket statements on the radio about do this or do that. You know, we always say something like, well, that depends, because it depends on the situation. Everybody's situation is a little different. All right, here's a lose. This is probably true for everybody unless there's extenuating circumstances. Begin your Social Security benefits when you turn 62, Ben.
Yeah, again, this is different for people, right? There are times when I would say, so the way that you can hurt yourself this way is, one, you're giving up a lot of future income. But if you're somebody that, you know, your family does not have long lifespans, and you say, look, I just want to get what I can get out of Social Security, then I get it. If you're a police officer or a firefighter and you're retired in your late 50s or early 50s, and you need that extra piece of income, or you're counting on that extra piece of income at 62, well, that makes sense. That may make sense for part of your plan to take Social Security and continue to delay taking from your retirement accounts, allowing them to continue to grow. So there are scenarios where that's a win, but I would say for the majority of time, we don't want to take Social Security at 62. We want to try to delay Social Security, get that extra income, that extra growth, because the more reliant that you are on Social Security for your retirement income, the less other investments that you have, and you know who you are, the more important it is to wait to take Social Security for this old age survivor and disability income, OA, SDI, that thing that you see on your paycheck. The goal for that is to give you some peace of mind in retirement. And that's what we want to look at when we take this.
Yeah, so the lose, of course, is beginning your Social Security benefits. You turn 62. We talked about the win. And there's some other wins, too, involved in this, because this segment is called Win, Lose, or Withdraw, Ben. So what are the other wins here?
Yeah, so the best way to maximize Social Security benefits is simply by delaying the age at which you claim, depending on how long you live. And to achieve this goal, you need to continue working until you hit your full retirement age. Now, again, that's not true for everybody. Sometimes we are trying to figure out how can we retire earlier, how can we enjoy the time that we have, how can we not, continue working forever. But again, that is a discussion that you have with your financial planner to see when you can retire, and another one. So your benefits might not be at the max if you do delay claiming until your own personal full retirement age. If that age is 66, 67, or very likely somewhere in between, your retirement benefits grow until you hit age 70. So if you claim prior to that milestone, you might be leaving some money on the table. So it's important to know that Social Security will continue to grow at 70 just because it says your full retirement age is 66 or 67. You could theoretically get more money at 70. And if you don't need it at 66 or 67, there's no reason necessarily to take it. Usually, I wouldn't say there's usually not a reason to take it. So we want to keep all these things in mind as we're planning when to pull the trigger.
Yeah, and, it depends on your situation again. And you could take it, like Ben said, from 62 to 70. Now, there's no sense in waiting past 70 because it maxes out. If you can wait to 70, your benefit's going to be about 130%. Also, you get the cost of living adjustment. Last year was great, was 8.7. This year coming up, I guess 2024 is going to be around 3.2%. So that's
3.2%. But you get that cost of living percentage either way. So whether you've taken it or whether you've delayed it, you're still getting that 8.7 from last year. You're still getting the 3.2 from 2024. So don't let that play into the decision. I mean, that's something that we can't control. Right? We can't control what they give us for inflation increases, but it is important to know what the expectations are.
Yeah, I thought they penalized you. Say, no, you're not getting it. You didn't.
No.
That would be mean. All right. By the way, the show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want to give you the phone number. Get on Ben's calendar to get yourself all set up. With a confident plan to retire, you want to be stress-free, peace of mind. And that's what you want when you retire. And it starts by picking up the phone and punching those numbers in. 800-380-8985. Folks at Fuchs Financial are standing by. 800-380-8985. Do it right now. Your chance to benefit from the How to Retire Blueprint. All right. Gone through a couple of different scenarios. Let's do another one here. Okay, here's a lose. Withdrawing from your 401k and IRA before RMDs kick in, Ben.
Yeah, so I think for a lot of people, the idea is to delay taking from your 401k to let it grow as much as possible. I mean, if you can retire at 59 and a half, but you let it sit for another, we'll call it 13 and a half years till you're 73, or even later until you're 75, depending on when you were born, you're going to have obviously a lot more growth in there through the compound interest, we hope, assuming that it was invested, correctly. But there are scenarios where we don't want to wait until RMDs kick in. So sometimes a win in the scenario is looking at how much you'll have to pay when it comes to RMD time. For example, let's say Gary retired at 60. He's got $1 million in his 401k. He leaves it alone until he's 73, and then he has to begin taking it out. Well, over that 13-year period, depending on how it was invested, very likely that it will have more than doubled. But let's just say it doubled. So we got one from $1 million to $2 million. Now Gary is forced to take out over $70,000.
Wow.
We'll say 4%, so we'll actually say $80,000. Let's say he doesn't need that money. Well, that's going to cause the Social Security that wasn't previously taxed to be taxable. It could push them into a higher rate. It could cause capital gains that weren't previously taxed to become taxable. So we want to be cognizant of the impact of required distributions on your income level now and in the future and decide, does it make sense to withdraw early? Does it make sense to withdraw late? Let's keep that in mind as we go forward.
I like the $2 million, despite that, Ben, I like the $2 million scenario that I have in my bank account. And, that I like a lot. So,
I don't want to take anything away from you, Gary. I don't want to let people know what you're really, we know it's somewhere north of $12 million. That's all I know.
Exactly. That's why I'm still working here, Ben. All right. So let's get to another lose.
Labor of love, Gary.
Oh, absolutely it is. No question about that. I love doing these shows each week with you. All right, lose. Draw from your Roths when you still have other streams to pay. And we have 4 different wins here on this one now, Ben.
Yeah, so this is a big one. So this is a big one for me. I would say in 99% of cases, you are going to lose when you take money out of your Roth, when you have other options there. When ideally you want to wait before withdrawing money from your Roth IRA for as long as possible. Why? Taxes. You pay the tax up front, meaning that you can't take money out of your Roth IRA and it won't count as taxable income. So the win is that continuous compounding of interest. So let's take Gary's scenario that we had before. Instead of having $1 million in the IRA, he has $1 million in the Roth IRA. He lets that sit until he's 73. He has $2 million in that Roth IRA. He can take as much or as little out as he wants. It has no impact on his taxes. He's already paid the taxes when he put that money into the Roth. Anything that grows is not taxed. So incredibly important. All those things that we talk about and that we worry about with required distributions are the opposite when it comes to Roth IRAs. So again, we want to play that in, and also keep in mind that if your goal is to leave money behind to the next generation, they will also inherit this money tax-free. They have to take it out over 10 years, just like with IRA rules. But when they take the money out over 10 years, you've already paid the taxes. They don't. So if your goal is to keep yourself from paying taxes, keep your next generation from paying taxes, it is a huge option. But that doesn't mean that it's right for everybody. It does not mean that everybody should just put all of their money into a Roth IRA. I've had a lot of scenarios where they should not do that. But you don't really find that out until you sit down and meet with one of us. And we run a lot of different scenarios. When we create our How to Retire Blueprint for each individual, we're doing that with the goal of helping them as much as we possibly can by giving them a number of different options. We probably run 7 or 8, 9 different reports depending on where your investments are, what type of risk tolerance you have, what the goals are, how expensive, what kind of fees you're paying in that account, what the tax implications are of doing nothing versus making some changes, and what are the most efficient ways of creating those tax changes for you. Those are all things that we do for you when you come in for an appointment with us. And you don't have to come in. You can do a Zoom. Anything works. But the goal is to be able to help you, to be able to put you in the best position for retirement. You know, we have 3 other advisors here, so we work together as a team on everything, and we have a system that we use when we're evaluating all of our clients. So no matter if you're sitting down with me or Gina or Alex or Eddie, we're all here to help you create a plan that is going to work for you in retirement.
That's a great advice, Ben. Of course, Ben, being a fiduciary has your best interest in mind, by law, and that's going to help you quite a bit, separates Ben from the other guys out there. And let me give you the phone number right now. Get on Ben's calendar, 800-380-8985. Your chance to benefit from that How to Retire Blueprint. Call right now. We still have a limited number of availabilities on our calendar this week, and the consultation is offered at no cost or no obligation. What are you waiting for? You deserve a more confident plan to retire. You want to be stress-free. You want peace of mind. We call it SWAN. I like to call it SWAN. Sleep well at night. There you go, SWAN. 800.
Oh, like SWAN. That. I thought you said swamp. I was going to say, I don't want that to be the retire. Okay,
no, SWAN. Sleep well at night. Yeah. 800-380-8985. 800-380-8985. Get the How to Retire Blueprint. Folks at Fuchs Financial are standing by. All right. Great segment, Ben. We are going to take a short break. Back with more of Ben and How to Retire in just a moment. What's up next?
Planning for income and retirement is one key to success. How do we begin, and what do we do first? When we come back, we'll outline the questions to ask and answer as you begin that all-important retirement and income plan. Stick around.
We believe in better. A better way to invest. A better way to serve you. And a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
We'd like to welcome you back to the show. I'm Gary Nolan, your consumer advocate. The show is How to Retire with Ben Fuchs. And Ben is here to help you take charge of your money. A little bit about Ben, if you're just joining us. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary, over 20 years experience in the business. Each week we talk about things we know that you retirees or pre-retirees are vitally interested in, whether it's wealth accumulation, asset protection, long-term care. We talked a lot about these things, Social Security, and so much more. All right, so let's get back to the show. But before I do, I want to give you that phone number. Get on Ben's calendar. Get yourself all set up with that How to Retire Blueprint. 800-380-8985. 800-380-8985. Folks are standing by at Fuchs Financial. Get the How to Retire Blueprint. All right, planning for retirement income, while not rocket science, is pretty complex. For example, here's a list of questions on a comprehensive plan that will address these issues. Ben, there's about 7 or 8 bullet points here, so I'll let you go through these. And what can you tell our listeners about income planning?
Yeah, so the first is, when do you and your spouse claim Social Security benefits if you have them already? Now, obviously, this is incredibly important. It's something that impacts the vast majority of people. And what we find is that most spouses want to retire together and claim at the same time. And typically when you come in, that is not the recommendation that we'll have. But I mean, that's something that we'll get into when you come in for an appointment. But you want to stagger that stuff. You don't necessarily want to have the same income, but there are a lot of different nuances to that. And getting that right is absolutely critical. The next bullet point is, what is your budget, including taxes, and how will it grow or decline in the future? Now, budget is important. What I like to figure out for my benefit is how much are you spending now? What is your current lifestyle? Let's figure that out. And then from there, we can create a plan based on your budget. But I don't like to say budget because nobody likes that word.
I hate it, yeah.
We can say, yeah, right? I mean, it's like, I don't know. It's like, I'd rather have bumpers in a bowling alley, right? I want to make sure that, when it comes to your income, you don't want to go too far to one side. You'll end up in the gutter, and that'll be a problem. But if we can put up guardrails and say, all right, look, you know how much you can spend if you're going a little crazy, if you're going on vacation, you know how much, to drop it to. But we don't want to go in the gutter, right? We want to make sure that we're able to make it to the finish line there. So, and that might be hard when you have little kids that are bowling with you, like I do sometimes. You wonder if the ball's ever going to get there. But that's a different story.
It really is.
Yeah. So, I think that's important. It's also important to know that obviously whatever you're spending now, you'll be spending more in the future. And then, at some point it will be less because you just won't be doing that much. I mean, I've had couples that say, look, I've traveled around the world. I'm good. I don't need to travel. I'm very happy to be home. I'll spend money when my grandkids come or, whatever that is. But, they don't need to do that. They've seen everything they want to see and they're very happy to be at home. So spending does take a different turn down the road.
Yeah, we call it a spending plan. A lot of people like that word better than a spending plan. And, one thing, Ben, you talked about this in prior shows, too. You want your lifestyle in retirement to match up as closely as possible to when you were working. I mean, you really don't want to, sit around eating ramen noodles and counting pennies. So, I mean, that's
right. I'm with you. I think that's to me, that's critical. I think a lot of people go into retirement saying, all right, I know I have to cut my spending. What can I do? And I think the real question is that valuable to you, right? Does it make sense for you to say, yeah, I do want to cut my lifestyle? Or, hey, is it worth it for me to keep working for another year or two to get more income? I remember one time I was working with a teacher and she had 17 years in and they didn't have a lot of savings. And in Connecticut, you really, you do better in the pension after you got in the 20th year. And of course, more after that. But I was pleading with her to work another couple of years because she would have gotten so much more money from the Connecticut teachers pension system if she continued to work. But she just said, no, I don't want to do that anymore. I'm done, which it's her right? She has a right to do that. And I also respect that. But, the long-term implications of somebody living to 90, retiring at 61 versus retiring at 64 for her just made a big difference. But I think it's important to have that information and to understand that before you make a decision either way. Another bullet point on here, and plans for any legacy, kids, grandkids, charity. I've got a lot of clients that have no children, which is perfectly fine. And so some of them say, I've got some nieces and nephews and I wouldn't be in mind giving them some things, but I have no interest in making them wealthy. And so that opens up the door to some potential charitable giving, some potential tax advantages to starting to give that money away while you're alive and taking advantage of that now. So, we ask a lot of questions when you come in to meet us because it's our goal to figure out what we can do to help you and put you in the best position for retirement. But that's why we have these openings on our calendar each week. That's why we do this so that we can go through these bullet points. Obviously, we want to figure out what should you do with your 401k balances. So we move it to an IRA or to a Roth IRA. The benefit of moving money from a 401k or 403b or a thrift savings plan or 457 to an IRA is that you have more investment options. You have very few, typically, investment options inside of a 401k. And when you do, half of them are target retirement date funds, and then you might have a few other funds, but that's about it. Understand that there are more than 5,000 mutual funds out there. There are more than 20,000 mutual funds out there. And there are lots of other options that are available to you to invest that aren't available inside of a 401k. So we move money from a 401k to an IRA to take advantage of those other options. There is no taxable event moving money from a 401k to an IRA. It is a non-taxable event. Mm-hmm. So you don't lose any money by doing that. You just typically have to be over 59 and a half or have an orphan plan, a company that you used to work for that you don't work for anymore. So if that's you and you have money that's sitting around that you haven't touched in a long time, that would be a great reason to give us a call because we can likely help you invest that and invest it in a different way than it is in the 401k. That's likely more tailored to your retirement.
Yeah, let me jump in, Ben, and give everybody the number. You're talking about folks need to come see you because these are the scenarios that folks will have questions about and the different scenarios we talk about here on the show on this particular segment. segment here. So the How to Retire Blueprint, call 800-380-8985, 800-380-8985. Get the How to Retire Blueprint. I'm Gary Nolan, your consumer advocate. The show is How to Retire with Ben Fuchs. Let's see, we've gone over 2 or 3, 4 of these bullet points. Now, let's see. How about the next one, Ben? Should you invest your personal after-tax savings in high dividend stocks?
Yeah, and this is totally dependent on the people in front of me. So some people absolutely, some people definitely not. The high dividend stocks means that it pays an income for you every year, every quarter you get a dividend. That dividend is also taxed. So depending on what tax bracket you are, it may make more or less sense for different people. But again, these are things that we want to be able to go through together. What should you do with equity in your home? Should you pay down the mortgage or should you draw down values? This is important because, if you have one of those old 3%, 3.5%, 4% mortgages, my advice is almost never to pay that down. We can get a CD that pays us more than our mortgage. The bank would love for us to pay that down so that they can loan more money out. And as a general rule, I think you typically want to do the opposite of whatever the banks want you to do. So, no, but in all seriousness, there's a technical term called arbitrage. Arbitrage is when you can, invest money in one place, get a lower rate for it, and invest it in the same type of investment somewhere else and get paid higher, which is what you do when you have money that you're getting a loan for on a mortgage, and then you can take that same money that you're not paying into paying off the mortgage early and put that into a CD. Why pay off a 3.5% mortgage when you can get a 5.5% CD? So we want to be smart with what we're doing with our money. We want to make sure that we're doing the right thing. Sometimes you kind of get stuck in these patterns of, I've got to get rid of all of my debt. And in some cases that's true, but not always. Let's talk about other sources of income. We need to generate a paycheck for yourself when you're retired. So how do we get that paycheck? Where does that come from? Well, it has to come from your investments. So we want to get a paycheck for you from your investments when you retire. Some people hear that and they say, oh, well, an annuity. Sometimes. But sometimes, no. There are a lot of options outside of annuities where you can generate income. And the benefit of those other investments is that you can maintain your principal and generate an income as opposed to drawing that principal down like you typically do with an annuity. Now, there's a case to be made for each, but which direction you go in depends entirely on your goals. And then also, last bullet point, long-term care, expanded health insurance coverage. Do you need it? Should you have it? How important is that to you? But that's something that has to be answered when you meet with a financial professional.
Mm-hmm. By the way, I thought Arbitrage was a 70s rock band. That sounds like, they had a lot of hits, don't you think, Ben? I thought they did. Anyway, but seriously, it's all about the income. I mean, that's what we're talking about in this segment. Am I right?
Oh, yeah. So after you understand how much income you can generate in retirement, you're ready to make the decisions that will flow from that knowledge, such as whether to downsize, how much you can spend on the grandkids, and how long that vacation can last. At the same time, you get a good handle on your taxes. And I don't know how many times we've said it or we've heard it. I don't know if you probably never heard this one before, Gary, but it's not what you make, it's what you keep.
Oh, yeah. I think I heard that once or twice. Yes, sir.
Oh, yeah. Once or twice. Yeah. So, this is incredibly important. When we look at the income that is coming for you in retirement, you typically have 3 things. You've got Social Security, you've got dividends and capital gains, and you've got withdrawals from your IRA or a pension. Now, those 3 things are all taxed differently from one another. The way that you combine those incomes could either be a wonderful thing where you pay almost no income tax at all, or it could be something where you're paying way more than you need to be because you didn't create a plan ahead of time. One of the things that we focus on with our clients is keeping as much of their money as possible. Sometimes it makes sense to pay more taxes 2-3 years in a row, rip off a Band-Aid so they pay less for the rest of their life. And in other circumstances, it does not. But when we create a plan, we will show you and explain to you and educate you on why it makes sense to do one thing versus another. But we can't help you do any of that unless you come in for an appointment. So we have openings on our calendar each week to help you decide when to take Social Security, how to minimize your taxes, how to generate a paycheck for yourself in retirement, and the best way for a legacy for your children or charitable giving, whatever makes the most sense for you as an individual or a couple. But we can't do any of that unless you come in for an appointment and sit down with one of our advisors and let us help you prepare for your best retirement.
Absolutely, Ben. The first step, like you said, sit down with Ben and the team at Fuchs Financial. Something we're talking about resonates with you. You feel need to get that second opinion. Want to make sure your plan is really aligned with your goals. Very important risk tolerance we've been talking about, too. Just pick up the phone. Punch those numbers in right now. What are you waiting for? 800-380-8985. Get the How to Retire Blueprint. You deserve a more confident plan to retire. Stress-free, peace of mind. That's what you want. 800-380-8985. Folks at Fuchs Financial are standing by. Get the How to Retire Blueprint. Do it right now. No cost or no obligation. All right, we're going to take a short break. We'll be back with more at Ben and how to retire in just a moment. What's up next?
All right, when we come back, it's time for questioners from listeners. They're asked and answered. All that and more right after this.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. And Ben is with us, back with us. He's here to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience in the business. I want to give you the phone number right now and get on the calendar. Get yourself all set up with that How to Retire Blueprint. Here's that phone number, 800-380-8985, 800-380-8985. By the way, each week we talk about things we know you're really interested in. Maybe you're in that retirement red zone we talk about. Maybe you're retired already, but you need to know about wealth accumulation, asset protection, Social Security strategies, long-term care, and so much more. And we try to address all these issues each week on the show. Got these questions that came into us, and let's get to them. All right. Josie in Glastonbury, I'm 49 years old. I made $300,000 last year. I only have $506,000 in my retirement plan at work. My partner is on disability, doesn't have a job, and doesn't have a 401k plan. I want to open a Roth IRA, but I'm not sure if I qualify. What options do I have to save money for retirement?
Yeah, this is tough. So one, you don't qualify for a Roth IRA, but you can contribute to the Roth option of your 401k at work. Now, for whatever reason, and don't blame me, I am just the messenger, but the federal government does not allow you to contribute to a Roth IRA if you make over a certain amount of money, which you do. Congratulations, Josie. Wonderful job. But for whatever reason, that same, prohibition, that same piece is not there on the Roth 401k. So you can make $2 million a year and still contribute to your Roth 401k. Now, with you being 49 years old, with you having $500,000 in your retirement plan, that money will continue to grow over the next 10, 15, 20 years, depending on when you decide to retire. It might make sense for you, even though you're at a high tax bracket, to contribute to that Roth option in the 401k. I can't be sure. I don't know how much you'll be spending. That will help me determine whether or not you should or should not contribute to the Roth option in your 401k. But depending on your spending and depending on your lifestyle, that's what we want to look at. Now, just because you can't contribute to a Roth IRA does not mean that you can't contribute after-tax money into an investment plan for yourself. I have plenty of people that felt like they were behind and needed to catch up on their retirement. So we used to set up a plan where they put in an extra $1,000 a month, $2,000 a month, $5,000 a month, depending on who you are and what you need and how much you need to catch up. That was the plan. So we've done that for a lot of people, and I will tell you it has made a huge, huge difference in their lives. So just because you feel like you're behind doesn't necessarily mean that you are, but I understand the feeling, and we can certainly help you figure the rest out.
Yeah, and Josie's got a long time horizon. She's only 49 years old. So, Josie, get a hold of Ben and the team at Fuchs Financial. Here's that phone number for you and everybody else listening right now. 800-380-8985. Get the How to Retire Blueprint, 800-380-8985. Let's move on to Al in Covington. I'm a little bit torn about my approach to retirement planning. On one hand, I want to really understand all the details about my plan, but I talked to a couple of financial advisors who act like I should just let them handle all the details, kind of a control freak, by wanting to know everything that's going on. Am I being a control freak? I don't know. I think Al has a right to know what's going on within his plan. It's like, to go to the doctor and say, no, don't worry about it. I got this all figured out. I don't need to tell you what your illness is. We got it covered. Am I right? This is kind of odd, don't you think, Ben?
Yeah. I don't. So first of all, it is not an uncommon practice in financial planning for the advisors to be like, I'm the professional. Let me do it. Don't worry about it. And I feel like that is wrong. If you've ever had an advisor tell you, when you ask about what fees you're paying, it's complicated, don't worry about it. We're treating you fair. No, tell me exactly what I'm paying. That is fair. First of all, it should all be public information, but I want to know exactly what I'm paying. And so when we do our reviews, and we do reviews twice a year for all of our clients, typically June, July, and then again in November, December. So first thing that I do is I turn the paper around and I say, look, here's how much you invested with us. Here's how much you made, and here's what you paid me. And they can decide, are we still worth it? Because that's important. We take our fees every month. We're like anybody else. I think that, people should know exactly what they're paying. Al, if you don't know what's going on in your investment plan, how can you make sure that it's the right thing for you? How can you give yourself a second opinion? So in a scenario like that, talk to another advisor, talk to us, talk to somebody else. I think it's important to get multiple opinions, but there's no harm in getting a second opinion for no obligation.
Yeah,
Understand what's going on, understand what your fees are, understand the risk tolerance, make sure that you're comfortable with it, because if you don't understand it, then you're really going to freak out when something goes wrong. You need to understand what the risks are before you go forward.
Yeah, that's where your fiduciary responsibilities come in, Ben. You have to be completely transparent and let people know exactly what fees they're paying and give them the best advice that's right for them, and that's by law. Am I right?
Absolutely. Yeah, no question about it. Now, just because you're supposed to be a fiduciary doesn't mean that everybody is, but
sure,
I think that you can get a gut feeling when you sit down with somebody, and that's really important.
All right, great advice for Al. Let's get to Margaret in Manchester, and here's Margaret's question. I'm 62 years old, and my retirement account is heavily invested in short-term investments. I plan to retire in 4 years. Is it appropriate time to move some of my stocks and bonds, move some of it into stocks and bonds?
So, Margaret, I'll tell you a couple things. I think it's very difficult for any advisor to tell you to move things away from things that are safe and things that are risky. When you are approaching retirement, when you are 4 years away from retirement, that is typically a time where we want to be more conservative. However, we have to look at your longevity. I met with a 75-year-old man the other day whose father lived past 95. My grandmother, God rest her soul, lived to be 102. If my grandmother had all of her investments in short-term pieces at 62, she would have absolutely had to move in with one of her two daughters by the time she was in her 80s. No question about it. But she didn't. And she had investments that grew with the market. And so sometimes when we want to maintain our independence, we have to take a little bit of risk. Now, how much that is up to you. But I think it's important to determine that and to have a conversation with your advisor. Can I get away with a 3 to 4 to 5% average rate of return over the next 30 years versus sometimes 10, sometimes negative 10, but overall on average a 8 to 9% return? Well, that's important. And so we want to make sure that we understand that any money that we put on the stock market, we don't plan to touch for at least 5 years. Better off if we don't touch it for 10. Because historically speaking, a lot of these will average between 7 and 9%, closer to that 8.5 range. And we obviously want to be able to get those returns, but in order to get those returns, we have to be comfortable with the roller coaster portion of the market. Now, in order to be comfortable with the roller coaster portion of the market, we still need to have safe money that we can pull to in the event of an emergency. I don't think you need to change everything, but I do think you should look at some reconfiguring.
Mm-hmm. And of course, it depends how risk-averse folks are, Ben. And we talk about the rule of thumb of 100. Let's say she's 62 years old, so that's 38% risk. But that's not for everybody, am I right? Everybody's a little bit different. And sometimes you're too conservative, am I right? That happens too.
Oh, yeah, absolutely. I've seen people that are way too conservative, but they have to be able to sleep at night. So it doesn't matter what rules of thumb anybody has. I mean, the most important thing is that you're comfortable and you can sleep at night. What's the point of putting money in the market to get long-term growth if that will give you extra heart palpitations, which we don't want?
Yeah, exactly.
So, the goal here is to figure out how can we best help you? What can we do to put you in the best position for retirement? And sometimes that does mean keeping more money safe than maybe you would normally recommend, but understanding and being comfortable with the risk you could conceivably take. Mm-hmm. I think that's also part of the goal. Yeah. Is that when you feel like you have a plan, all of a sudden you don't feel like everything is up in the air. So when you see something go down, you say, that's okay. I have a safe haven somewhere else.
All right. Great advice. All right. Final question. Couple of minutes left. Rick in Woodbury, can you explain the living benefit on life insurance? I never thought of life insurance as anything but a death benefit. I'm curious how this works. We could spend a whole show on this, Ben, let alone the whole segment.
Yeah. It's interesting. So first, my quick caveat is that in most times, unless you're a business owner with a very wealthy business, I don't necessarily recommend getting a big life insurance policy later in life. Sometimes it makes sense to convert one life insurance policy to another. That's a totally different ballgame. But to get a new big policy later in life, not always a strong recommendation. However, if you're a little bit on the younger side, life insurance can be an interesting tool for growth. One, there's a cash value that is inherent inside of that policy. And two, when you retire, you can take loans from that policy. One of the nice things about a home equity line is that you have equity in your house. You borrow money from that. You're not paying any taxes on the borrowing of the money. It's your money you're borrowing. You're paying interest on it. The same thing that you can do with life insurance. You can take loans from that policy without paying any taxes. Now, what are the internal fees is always the gotcha question. Living benefits also, you can add things like a long-term care rider onto a life insurance policy. So if you have $1 million life insurance policy and you're able to take 4% from that each month to pay for long-term care in the event that you need to go, that means you have up to $40,000 per month that you can use until you drain down that policy. If you can't do 2 or 3 of the activities of daily living, depending on the insurance policy. But those are things that you want to cover, not something that I would recommend you trying to figure out on your own. You want to find somebody that does a lot of that. So part of what we do as an independent fiduciary is that when it comes to anything where there's an annuity, I've been licensed with maybe 10, 20, 30 different insurance companies over the last 10 years. I do not care who I've been licensed with. It's just whatever I feel will give my clients the best product. And when it comes to life insurance, it is the same thing. I have been licensed with a number of different life insurance companies. I am not beholden to any of them. It's who will give my client the best policy. So our goal here is to figure out what makes sense for you. And sometimes, having life insurance with a living benefit makes sense. And other times it really is the absolute wrong thing. But it's worth having a discussion for. That's why we have appointments on our calendar each week. So when you have questions about life insurance, about Social Security, about your investments, about creating a paycheck from yourself, from your own investments in retirement, about minimizing your taxes, about creating a legacy, about charitable giving, how can we do that? How can we do that for you in a way that makes sense and make sure that we're accomplishing all of the things that you want to achieve in retirement?
Great advice, Ben. Boy, I wish we had more time to spend on this. Thank you for all your questions. I want you to get the How to Retire Blueprint. There's no reason not to do this right now. Punch the phone numbers in. I'm about to give you the phone number, 800-380-8985, 800-380-8985. Call right now. We still have a limited number of availabilities on our calendar this week. Consultation is offered at no cost or no obligation. It's a unique plan. It's a comprehensive plan. It's your plan alone. And again, no cost, no obligation. Folks at Fuchs Financial are standing by, 800-380-8985. Get the How to Retire Blueprint. Wow, we're up against the clock. The show has flown right on by. I'd like to thank everyone for listening. We hope you found the information we presented helpful. Look forward to all of you being back next week. We'll have new topics, new questions right here on How to Retire with Ben Fuchs. Ben, as always, it's been a pleasure. Go out and enjoy the rest of your week, and I look forward to chatting with you again next week.
Sounds good, Gary. Thank you very much.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.